Welcome to today's Explainer. We're jumping right in today to totally demystify the mechanics and, frankly, the intense psychology behind one of the most thrilling investment strategies out there. We're talking about growth stocks and what it actually takes to catch the future stars of the market.
So want to catch the market's future stars? I mean, really think about it. Are you drawn to the romance of the market? You know, that undeniable allure of finding the absolute next big thing way before it becomes a household name? It's a captivating idea, right? Finding that one rare company that's literally going to change the world and just riding its meteoric rise. But how do we actually spot them? And honestly, what does it take to hold on to them?
Well, to answer that, here is our roadmap for the Explainer today. Section 1. Meet the future stars. 2. 3 core characteristics. 3. The big reward. 4. The inherent risks. And finally, 5. Are you ready?
All right, jumping into Section 1, Meet the Future Stars. Let's define what exactly growth stocks are.
Okay, so by definition, growth stocks are companies with revenue and profit growth speeds that are significantly higher than your typical market average. But here's the absolute crucial point. Their core value? It absolutely does not lie in current cash payouts. Not at all. You see, you aren't buying them for what they're paying out today. You're buying them for the massive, explosive potential of what they are going to become tomorrow.
So what do these businesses actually look like in the wild? Well, they typically share 3 really distinct traits. First, they're positioned squarely in the expansion phase of their industries. They aren't stagnant, mature companies. Second, they possess disruptive technologies. And third, they feature disruptive business models. We are painting a picture here of just relentless innovation. These are the rule breakers, the companies entirely rewriting how the game is played.
Moving on to Section 2, 3 core characteristics. Let's look at the financial mechanics under the hood here. The first core characteristic we see is high earnings retention. Basically, this is a strategy where growth companies pay almost zero dividends. Instead, they retain their profits for strategic use. Let me ask you this. Are you comfortable completely giving up that predictable, cozy dividend paycheck? Because with growth stocks, the wallet stays firmly closed. They keep that cash because they believe, and honestly their investors believe, they can generate a much, much higher return by keeping it in-house rather than handing it back to you.
So what do they actually do with all that retained cash? They feed this relentless 3-step reinvestment loop. Step 1, generate initial profit. Step 2, immediately reinvest that profit directly into things like research and development, expanding capacity, or maybe aggressive mergers and acquisitions. And why? To fuel Step 3, expanding market share. This continuous loop is the absolute engine driving their competitive advantage.
And you know, this aggressive engine directly impacts their valuation. When comparing growth stocks to traditional value stocks, specifically looking at price to earnings or PE ratios, growth stocks command far, far higher PE ratios. Why is that? It's because investors are eagerly paying a premium today for tomorrow's earnings. This is a stark contrast to the lower ratios you'll see with slower-moving value stocks. To enter the growth game, you simply have to be willing to pay that high cover charge.
The third key characteristic is what we call the strong moat. Look, because these companies are growing so fast, they naturally attract fierce, hungry competition. It's inevitable. So they must build a moat to defend their aggressive market capture. Typically, this is built using things like patented technologies, incredibly powerful brand loyalty, or massive network effects. These are essentially the defensive walls that protect their high-speed growth from rivals trying to storm the castle.
All right, Section 3, the big reward. Let's talk about the massive potential upside. The primary attraction here, the whole reason we do this, is capital gains. As the sources point out, in a bull market, they are the main force creating excess returns. This is exactly why investors flock to these stocks. It's the sheer price appreciation. When things go right, I mean really right, the capital gains can drastically outpace the broader market. You aren't playing for tiny percentage points here. You are playing for exponential, market-beating excess returns.
To really put that into perspective, during upward market trends, growth stocks often see these massive price surges. They quite literally leave standard indexes eating their dust. These future stars absolutely shine the brightest when market conditions are highly favorable. That's when the magic of that reinvestment loop we talked about actually translates into explosive stock price momentum.
Now for Section 4, the inherent risks, we have to talk about the stark dangers. Because, let's be real, you can't have those massive highs without some pretty severe threats. I call them the twin threats. First up, macroeconomic shifts, specifically interest rate hikes.
Growth stocks are extremely sensitive to interest rates, mainly because higher rates make the massive profits they're promising in the future worth a lot less in today's dollars. The second threat? Missed expectations. If their growth engine falls even a tiny fraction short of the market's sky-high expectations, well, look out.
Because when those twin threats actually materialize, this is the brutal reality you face, the cliff-like drop. Remember, these stocks are valued super highly based on perfect execution in the future. So, encountering bad news or a rising rate environment leads to extreme valuation corrections, and we aren't just talking about a mild dip here. The sources describe sudden, dramatic stock price crashes. It is a sheer cliff-like drop that can literally wipe out portfolios if you aren't prepared for it.
Which brings us to Section 5. Are you ready? Let's profile the ideal investor for this.
This strategy is pretty much the ultimate test of your stomach for risk. It's a classic case of short-term pain versus long-term gain. The short-term reality of holding growth stocks involves high volatility and often significant, frankly terrifying paper losses. But the long-term goal? That's capturing the massive fruits of that enterprise growth. You have to be totally willing to endure the immediate sickening turbulence to ever reach that distant destination.
So, based on everything the sources tell us, here is the ideal investor profile for growth stocks. First, you need a high risk tolerance to handle those cliff-like drops without losing sleep. Second, you need a very long investment horizon to allow that reinvestment loop to actually work its magic. And third, perhaps most importantly, you absolutely need firm psychological resilience. This is the mental armor required to endure the wild journey without panicking and just selling everything at the absolute bottom.
So, I want to leave you with one final, very real question today. Do you have the firm psychological resilience to wait for the harvest? We've seen the incredible mechanics of these future stars, the massive, mouth-watering rewards, and those terrifying cliff-like drops. Now you know exactly what the stark reality of growth investing entails. So take a really hard look at your own investing temperament. Are you truly ready to ride the rocket ship? Thanks so much for joining me for this explainer today, and keep learning.